Hi, it's Brian Decker with your Market Minute. Want to talk to you about the item in the news in a big way this week, which is the CPI, the Consumer Price Index. So, how is the Consumer Price Index calculated? The measure uses a basket of goods, quote unquote, approach that aims to compare the costs of various consumer goods and services. These can include transportation, food, rent, haircuts, medical care. There's 80,000 items that are included in the report. And each month, data collectors from the Bureau of Labor Statistics call, visit, or check the website of thousands of retail stores, professional offices, and other establishments to assess nationwide price information. Specialists then examine the data for accuracy and make statistical adjustments given to any item's value. Now, there was some big outliers in this month's CPI, the Consumer Price Index measure of inflation. The Fed's target is 2% or less. And this month's came in at 4.2. The expectation was 3.6. Came in at 4.2 and rocked the markets Monday, Tuesday, Wednesday of last week. Gas prices, transitory spike because of supply chain issues. Used cars, transitory because of supply chain issues. New cars, transitory because of supply chain issues, particularly semiconductor shortages. Lumber, transitory supply chain issues. We've got lumber mills that are working full-time 24/7 to meet the supply after the demand had stopped. So the equilibrium has not yet been reestablished between supply and demand there. So we have a short-term spike. Van Hoisington and Lacey Hunt argue, as they have for years, that inflation fears are overstated. They believe that inflation will moderate by year end and undershoot the Fed's 2% target. In other words, they take the transitory side of the debate for different reasons than many others. They have four important points here. Number one, rebounding productivity, supply chain restoration, technology advancement are all disinflationary forces. Second, real per capita GDP growth continues to lose momentum as debt levels move higher. Third, poor demographic trends, aging population, lower birth rates, produce a negative real investment effect that outweighs rising wages. And fourth and final, if the pandemic leads to more domestic manufacturing, the new plants will employ robots, not people, thereby shrinking labor demand. They conclude that the trend in long bond yields remain firmly downward in the medium or intermediate and long term. So we don't have to worry, according to them, that inflationary pressures will be sustainable. It's Brian Decker. Hope you have a great week.